Welcome back to the Quarterly Call. All content is for informational purposes and is not investment advice. Please consult with an investment professional.
So hello, everyone, and welcome. Today, we're really digging into something pretty significant for the economy. That's the recent press conference with Chair Powell, from the Federal Open Market Committee, the FOMC. It just happened July 30th, 2025. And our goal here really is to cut through all the jargon, all the noise, and pull out the absolute most important bits of information for you to give you a really clear picture of, well, where the economy stands right now, and crucially, how the Fed is thinking about it all. We've gone through it carefully to find what really matters.
Yeah, exactly. And, for anyone tracking the economy, these FOMC press conferences, they're kind of our best view, really, into the Fed's strategy. It's so much more than just, oh, they changed rates or they're doing this with the balance sheet.
Yeah.
It's a chance to understand the why behind it all, the reasoning, the factors they're weighing, the data they prioritize. And we'll explore all that today, the nuances of the economy, the policy dance, even some of the broader challenges they're facing right now. It's about understanding their framework.
Okay, great. Let's dive right in then. The central decision, the headline from July 30th, the FOMC decided to leave its policy interest rate unchanged. So they're keeping that target range for the federal funds rate at 4.14 to 4.12%. And they also said they're continuing to shrink the balance sheet. Now, on the surface, no change. It might sound like, well, nothing happened, maybe even a bit passive.
Right, like they're just sitting back.
Exactly. But in this current economic climate, holding steady is actually a really significant decision, isn't it?
Yeah.
It says a lot about their assessment.
Oh, absolutely. It's anything but passive. Think of it like steering a large ship. Sometimes the most skillful move is to hold the wheel steady through choppy waters, not to constantly jerk it left and right. This decision to hold rates, it's deliberate. And to really get why, we have to go back to the Fed's core mission, their dual mandate.
Right, the two big goals Congress gave them.
Exactly. Maximum employment and stable prices. That's the bedrock. It's all for the benefit of the American people, as they always say. And every single thing they do, every statement, every rate decision, it's all viewed through that lens. Powell even said it explicitly in his opening remarks. He said, despite all the uncertainty out there, they remain squarely focused on those two objectives.
Okay, so let's break those down quickly. Stable prices, that means their 2% inflation target over the long run, correct?
That's the one. Not zero inflation, but a low, stable 2%. Predictable. And maximum employment, well, that's a bit trickier, isn't it? It's not just one number.
Yeah, it's not just the unemployment rate, although that's a big part of it.
Right. They look at the whole picture. Wage growth. Are people quitting jobs to take better ones? How many job openings are there? Are people participating in the labor force? It's a holistic assessment. So holding rates steady now, it's a calculated choice. They think this level of rates is what's needed right now to balance those two goals, bring inflation down without wrecking the job market. It's that soft landing attempt.
Okay, building on that holding steady idea, the chair used a specific phrase to describe their current policy stance. He called it modestly restrictive. That sounds, I don't know, maybe a bit gentle, given how high inflation has been. What does modestly restrictive actually mean in practice?
Yeah, modestly is an interesting choice of word, isn't it? But it's very intentional. It means they believe policy is putting some brakes on the economy, just not slamming them on. Think of it like this. Interest rates are high enough now to make borrowing more expensive. So businesses might pause on a big expansion, or you might think twice about financing a new car. It cools demand, gently. But, crucially, it's not seen as so restrictive that it's causing major economic pain or, widespread layoffs.
So it's restrictive enough to fight inflation.
Hopefully, yes, enough to temper it, bring it down gradually, but not so restrictive that it crushes growth or jobs. That's the needle they're trying to thread.
And why is this particular stance, modestly restrictive, considered the right one for now?
Well, it comes back to the data and the mandate. Inflation, while down from its peak, is still, running above that 2% target, even if you strip out the new tariff effects we'll talk about later. So they can't declare victory on inflation yet. Policy still needs to lean against it. But at the same time, the labor market is still quite strong. We'll get into the details, but it's broadly seen as being in a good place near maximum employment. So you've got inflation still too high, but employment looking solid. That combination, in their view, calls for policy that restricts, but only modestly.
So it's not just waiting around. It's an active choice to keep this specific level of pressure on.
Exactly. It positions them to react if things change without having already over-tightened or, loosened too soon. It's active calibration.
So we have this modestly restrictive policy trying to balance things. Yet the chair also said the economy is in a solid position but faces elevated uncertainty. Sounds, well, almost contradictory. How can the economy be both solid and grappling with elevated uncertainty simultaneously?
It does sound like a bit of a paradox at first glance, doesn't it? But it's really about looking at different aspects of the economy. When Powell says solid, he's pointing primarily to the labor market. That's the bedrock.
The jobs picture.
Exactly. The unemployment rate is low, 4.1%. Job gains are still happening. Wages are outpacing inflation. By many measures, the job market is, as he put it, at or near maximum employment. That's the solid foundation.
Okay, that makes sense. So where does the uncertainty come in?
The uncertainty comes largely from external factors, things outside the sort of core functioning of the U.S. economy and outside the Fed's direct control. The big one right now, clearly, is government policy, especially these new tariffs and the ongoing trade dynamics. The full impact of those is still, well, uncertain.
So it's like the ship's engine is running well, the crew is capable, that's the solid part, but there are unpredictable storms or currents on the horizon.
That's a great analogy. The underlying economic engine, particularly the labor market, is strong. But these external forces, tariffs, global growth questions, maybe other geopolitical things, create unpredictability. They demand caution. So it's not a contradiction. It's a realistic assessment of the current landscape. Fundamental strength facing potential but unknown headwinds. And the Fed has to navigate through that.
Okay, let's dig into those economic indicators a bit more, starting with growth. The press conference materials mentioned a moderation in economic activity. GDP grew at, 1.2% pace in the first half of this year. That's definitely slower than the 2.5% we saw last year.
Yeah, a noticeable slowdown in the first half overall.
Though Q2 itself was stronger, around 3%. But the Fed seemed to downplay that Q2 number a bit, focusing on the first half average. Why do that?
Right. They specifically mentioned wanting to smooth out unusual swings in net exports in that Q2 number. Net exports, the difference between what the U.S. sells abroad and buys from abroad, can be really volatile quarter to quarter.
Especially now with trade stuff.
Exactly. Tariffs, global demand shifts. It can bounce around a lot and distort the underlying picture of domestic strength. So by looking at the first half average, they're trying to get a cleaner signal of the underlying trend in the U.S. economy itself.
And what is that underlying trend telling them? What's driving the moderation?
Well, the moderation largely comes down to consumer spending. That's the biggest engine of the U.S. economy, as you know. When consumer spending slows, the whole economy tends to slow.
So people are just buying less stuff, going out less?
It's slowing down, yes, not collapsing, but the growth rate has definitely cooled compared to before. However, it's not all slowing. Interestingly, business investment, particularly in equipment and intangibles like software, actually picked up.
Oh, that's interesting. So businesses are still spending in some areas.
It seems so, which suggests maybe some underlying confidence, perhaps driven by technology upgrades or capacity building. It's a mixed picture.
The Fed mentioned a specific measure they prefer over just GDP, right? PDFP.
Ah, yes. Private domestic final purchases, PDFP. It's a mouthful, but it's important.
Why do they like that one better?
Because it strips out government spending and those volatile net exports we just talked about. It focuses purely on private spending within the U.S., consumers buying things, businesses investing. Powell called it a narrower but better signal of underlying private demand, and that measure also showed some deceleration.
Did that raise concerns that maybe policy was too restrictive? I think a reporter asked about that.
Someone did, yes. They asked if decelerating PDFP meant policy was already biting too hard. But the chair pushed back a bit. He emphasized looking at the totality of the data, especially the strong labor market and inflation still being above target. His take was that, viewed holistically, policy doesn't seem inappropriately tight right now. It's about the whole dashboard, not just one gauge.
Okay, let's pivot to that dashboard's brightest light then. The labor market. You mentioned it's the anchor of the solid assessment. Conditions are still described as solid. Payroll job gains average 150,000 per month over the last 3 months. Unemployment is low at 4.1%. Hasn't really budged. Wage growth moderate, but still beating inflation. Sounds pretty good.
It does sound good, and by historical standards, it really is quite strong. But again, the Fed looks deeper than just those headline numbers. They use that phrase broadly in balance. What does that mean? It means they're looking at a whole suite of indicators.
Like what?
Things like the quits rate are people voluntarily leaving jobs, usually for better ones. That signals confidence. Job openings, how many positions are businesses trying to fill, that signals demand. Wage growth, is it sustainable? And when they look at all these things together, the picture suggests a labor market that's cooling a bit, but in a balanced way.
Balanced how? Job growth is slowing from the really hot pace we saw before.
Yes, demand for workers is slowing, but, and this is key, the supply of workers is also slowing down.
So fewer people entering the job market.
Exactly. Powell specifically mentioned factors like changes in immigration policy reducing the inflow of workers. So if demand for workers eases off, but the supply of available workers also eases off at roughly the same pace.
Then the unemployment rate can stay stable, even if job growth isn't booming.
Precisely. It's like two sides of a scale moving down together. The balance point, the unemployment rate, doesn't shift much. That's why they see it as in balance, not necessarily weak.
That's a really helpful way to think about it. But did they acknowledge any risks? Any potential cracks?
Oh, definitely. The chair explicitly mentioned downside risks to the labor market. They're watching very closely for signs that this slowdown could accelerate unexpectedly. Maybe a shock from somewhere else in the economy, or maybe demand just cools faster than supply. That could upset the balance.
So they're not complacent about it.
Not at all. There was a question about an equilibrium job growth number, like what's the magic number of jobs per month the economy should be adding? But Powell steered away from giving a specific number. He kept bringing it back to the unemployment rate as the key indicator, because that rate captures the outcome of that complex supply and demand interaction. Is the market clearing efficiently? Are people finding jobs? That's what the unemployment rate tells them.
Okay, so growth is moderating but mixed. Labor market is solid but balanced with risks. What about housing? That was singled out as remaining weak. This hits home for a lot of people, literally. Buying, selling, renting, it's tough out there. What's the Fed's role or view on this persistent housing weakness?
Yeah, housing is definitely the persistent weak spot in the reports. And it's tricky because people often directly link Fed rate hikes to mortgage rates.
Well, don't higher Fed rates mean higher mortgage rates?
It's related, but not one-to-one, especially for fixed-rate mortgages.
Yeah.
The Fed sets the overnight rate, the federal funds rate. Mortgage rates, particularly the common 30-year fixed, tend to follow longer-term Treasury yields, like the 10-year Treasury note.
And those are influenced by other things, too.
Many other things. Market expectations about future inflation, future Fed policy, global demand for U.S. debt, overall economic growth prospects. It's complex. The Fed's actions are a big piece, but not the only piece influencing mortgage rates.
So the Fed can't just flip a switch and lower mortgage rates easily.
Not directly, no. And Powell also pointed out a huge structural issue, the long-term housing shortage in the U.S. We just haven't built enough homes for years to keep up with demand.
Right. Supply and demand fundamentals.
Exactly. And that lack of supply pushes prices up, making housing unaffordable almost regardless of the interest rate level. That's not something monetary policy can fix.
So what can the Fed do for housing, in their view?
Their view, essentially, is that the best contribution they can make is to achieve their overall dual mandate. Powell put it very directly. The best thing that we can do for housing is to have 2% inflation and maximum employment.
Create a stable economy, basically.
Create a stable, predictable economic environment. That stability, they believe, is the best foundation for a healthy housing market in the long run, even if it doesn't solve the immediate affordability crunch or the supply shortage. Their focus is macroeconomic stability first.
Okay, let's shift focus to the other side of that mandate, inflation. It's come down a lot from the peaks of mid-2022, which is good, but it's still, as they said, somewhat elevated. The latest numbers showed total PCE inflation at 2.5% year over year, core PCE at 2.7%, both still above that 2% target.
Right. Progress, definitely, but not mission accomplished yet.
But the really fascinating thing you flagged earlier was the change in where that inflation is coming from. The composition has shifted. Can you walk us through that?
Yes, this compositional shift is really important for understanding where we are now. For a long time, maybe the last year or two, the big headache was services inflation.
Things like rent, haircuts, restaurant meals.
Exactly. Those prices were really sticky, as economists say. They weren't coming down easily. That was the main battleground. The good news, Powell said, is that services inflation is now coming down nicely.
Why? That restrictive policy working?
That seems to be the interpretation, yes. Higher rates, cool demand, make borrowing more expensive for service businesses, and that eventually filters through to slower price increases. So progress on that front.
Okay, so what's the catch?
The catch, or the twist, is that goods inflation, the price of physical stuff, cars, appliances, electronics, clothing, which had actually been behaving quite well, maybe even falling in some cases.
Yeah, I remember supply chains easing help there.
Right. But now, goods inflation is starting to go up.
Oh, so it's like playing whack-a-mole. You get services down and goods pop up.
It kind of feels that way, doesn't it? It means the inflation drivers are changing. And a big reason for this emerging goods inflation seems to be this new factor.
Tariffs.
Tariffs. The press conference explicitly highlighted increased tariffs as a significant factor now, pushing up prices in some categories of goods.
And it's affecting expectations, too. Near-term inflation expectations have apparently moved up because of tariff news.
Yes, both actual prices and near-term expectations are being influenced.
So how seriously is the Fed taking this tariff impact? How worried are they?
They're taking it very seriously, but they also acknowledge it's still quite early days in seeing the full effects play out. They know substantial amounts of tariff revenue are being collected, so the scale is significant. And critically, their analysis suggests the cost isn't really being absorbed by the exporters abroad, lowering their prices.
So the foreign companies aren't just eating the cost.
Mostly not, it seems. The evidence points towards companies here in the U.S., the importers, the wholesalers, the retailers, those upstream from the consumer bearing the initial cost.
But that won't last forever, presumably.
Powell was quite clear on that. He said it's starting to show up in consumer prices, and he added that surveys show companies have every intention of passing those higher costs along to us, the consumers. It's just a matter of time and degree.
So are these one-off price bumps, or could it restart broader inflation? What's the Fed's base case?
Their reasonable base case, as he termed it, is that these will likely be one-time price effects, meaning the price of a tariffed good goes up once to reflect the tariff, and then it stabilizes at that new higher level, a one-time shift in the price level, not an ongoing rate of inflation from the tariffs themselves.
But there's a risk it could be worse.
Absolutely. He explicitly acknowledged the risk that the inflationary effects could instead be more persistent. Maybe it triggers price hikes in related goods, or maybe it feeds into wage demands.
And that's where inflation expectations come in again.
Precisely. That's why they feel such a strong obligation to keep longer-term inflation expectations well anchored. If people start thinking, oh, inflation is going to stay high because of tariffs and other things, then that expectation itself can drive ongoing inflation.
The self-fulfilling prophecy idea.
Exactly. They need to prevent that. They need to ensure that this tariff shock doesn't become embedded in psychology and lead to an ongoing inflation problem. That's central to their goal of managing inflation efficiently, tackling it without causing more economic damage than necessary. They're vigilant about that spillover risk.
It's reassuring, though, that despite those near-term tariff worries, the Fed believes most measures of longer-term expectations remain consistent with our 2% inflation goal. Why is keeping those long-term expectations stable so absolutely vital?
It's arguably the cornerstone of modern central banking, because if long-term expectations become unanchored, if people and businesses start believing inflation will be, say, 4 or 5% year after year indefinitely,
then they'll act accordingly, asking for bigger raises, raising prices more aggressively.
Exactly. It becomes embedded in contracts and wage negotiations and business planning. And then it does become 4 or 5% inflation just because everyone expected it to. It makes the Fed's job incredibly difficult, requiring much harsher measures to bring it back down.
So maintaining public confidence that they will get inflation back to 2% eventually is paramount.
It's paramount. It means temporary shocks, like these tariffs, are seen as just that temporary and don't fundamentally shift behavior. People trust the Fed will do what it takes.
There was an interesting related question about whether the Fed, just holding steady, this wait-and-see approach, might actually give companies cover to raise prices anyway, blaming the uncertain environment.
Yeah, that was a sharp question. Does the Fed's stance create an opening for opportunistic price hikes? The chair pushed back on that interpretation. He argued it's not the Fed's policy stance that gives cover, but rather companies sometimes take advantage of the general environment.
He gave that example about washing machines and dryers.
Yes. Fascinating example from a prior tariff episode. Washing machines got tariffed, dryers didn't, but dryer prices went up too. It suggests that sometimes when there's a general narrative of rising costs or uncertainty, some firms might just, raise prices because they feel they can, because competitors might be doing it, even if their own specific costs haven't risen that much.
Sort of like keeping up with the Joneses on pricing.
Kind of. So while the Fed monitors that behavior, their main focus remains on ensuring it doesn't destabilize those crucial long-term inflation expectations. That's the real anchor.
Okay, let's look ahead then. The path forward. Policy remains data dependent. That's the mantra. What specific data are they really watching closely to guide future decisions, say, for this September meeting?
It really is about the totality of the evidence, as they always stress. It's not just one magic number. They'll be scrutinizing all the incoming data on economic activity, so consumer spending reports, business investment numbers, housing data, industrial production, and of course the big ones, employment and inflation. They'll get 2 full months of jobs reports and 2 full months of inflation data, CPI and PCE, between the July meeting and the September meeting. That's a lot of fresh information.
So they'll have a much clearer picture by then.
A clear, updated picture, yes. And they'll also be assessing the evolving outlook. How do these new data points change their forecast for the future? And critically, how does it affect the balance of risks?
Meaning the risk of inflation staying too high versus the risk of employment weakening too much.
Exactly. Which risk seems more pressing based on the latest numbers? That balance is key to their decision-making. And that's why Powell was very careful to say, no decisions about September have been made yet. They need to see that data first. It's a continuous process of asking, is the current rate still the right rate given everything we now know?
Okay. Now, related to uncertainty, a reporter noticed something subtle. The phrase uncertainty has diminished was apparently removed from the FOMC statement this time. Should we read that as uncertainty actually increasing?
The art of Fed watching and statement dissection. It's a subtle point, but important. The chair's explanation was that the removal didn't mean uncertainty increased. It just meant that uncertainty didn't diminish further compared to the last meeting.
So it just stayed high, didn't get any better.
Basically, yes. The elevated level of uncertainty persisted. It wasn't necessarily worse, just not improving during that specific period between meetings. And regarding trade, even though some deals are done and we know more about tariff rates now, the economic effects are still unfolding.
Like those price increases we talked about.
Right. And the overall process, the negotiations, the potential for new developments, Powell said it feels like we're still a ways away from seeing where things settle down. It's still very dynamic. So while some pieces of the puzzle might be clearer, the overall picture still contains significant unknowns, keeping that level of uncertainty elevated.
Now, inside the Fed itself, there wasn't complete agreement at this meeting. 2 members dissented, right? They actually wanted to cut rates by a 1/4 point.
That's right. 2 dissents in favor of a cut.
What does that tell us? Is the committee divided? And what were the different arguments?
While dissent isn't necessarily a sign of dysfunction, the chair actually framed it as a healthy part of their process. He said they want clear explanations and thoughtfully argued positions from everyone, including dissenters. It shows robust debate.
Okay, so what was the majority argument for holding steady?
The majority view, as articulated by Powell, boils down to that balance we discussed. Inflation is still a bit above target, while maximum employment is at target. Therefore, policy needs to remain modestly restrictive to gently guide inflation back down. The inflation mandate takes precedence right now.
And the dissenters who wanted a cut, what was likely their reasoning?
We don't have their specific statements here, but typically dissenters arguing for a cut in the situation might be more worried about the growth outlook or the downside risks to the labor market. They might feel that policy is already too restrictive, perhaps seeing the moderation in growth or the slowing job gains as signals that a rate cut is needed now to avoid an unnecessary slowdown or damage to employment.
So a different weighting of the risks, essentially. More worried about jobs than inflation at this point.
Likely, yes. Or perhaps they have more confidence that inflation is already firmly on a path back to 2% and doesn't need the current level of restriction. It's about interpreting the same data through slightly different risk assessment lenses.
Powell also mentioned the June economic projections, the ASEP. He said that's not necessarily the committee's current view.
Right. He cautioned against treating the June S&P forecasts as set in stone. Those projections are made quarterly, and things evolve quickly. The data they have now in late July is different. So the committee's thinking adapts in real time. It's not rigidly tied to forecasts made weeks or months earlier.
So if policy is modestly restrictive now, and the majority wants to keep it there for a bit longer, what would actually trigger a rate cut? What conditions need to be met? Do they need to see the labor market really weaken significantly first?
The trigger point revolves around that balance of risks shifting. Right now, the risk of inflation staying too high outweighs the risk to employment in the majority's view. A move towards cuts would likely happen when they see evidence that those risks were moving into balance. Meaning, either inflation comes down much more convincingly towards the 2% target, maybe even looks like it might undershoot, or they see clear, undeniable signs of a significant weakening in the labor market, a sustained rise in unemployment, for example.
So if one of those happens, the balance shifts.
Exactly. If the balance shifts, it would imply that policy shouldn't be restrictive anymore. It should perhaps be more neutral or even supportive if the labor market is really faltering. But again, Powell stressed there's no preset course. They don't know exactly what the neutral rate is. It's not a mechanical process.
It's based on the totality of the evidence again.
Yes, including things like, does that goods inflation from tariffs start bleeding over into services? Does the labor market slow down, remain orderly, or does it accelerate sharply? They'll be watching all of it. And they're aiming for efficiency, trying to time any moves just right, not cutting too soon and letting inflation reignite, but also not cutting too late and causing needless damage to jobs. It's a tough judgment call.
Okay, moving beyond the core mandate issues, a few other interesting topics came up. Fiscal policy, for one. A reporter asked about this big bill, the one big bill, and whether it would stimulate the economy in 2026. What was the Fed's take?
Yeah, the Fed always prefaces comments on fiscal policy by saying they don't make judgments on legislation itself, which is appropriate given their independence.
Right, separation of powers.
Exactly. But purely from an economic impact perspective, their assessment of this one big bill was that it's not particularly stimulative.
Why not? It sounds like a major piece of legislation.
Because, as Powell noted, the biggest part of the bill was making permanent existing law on taxes. So it avoids a potential future tax increase, which might have dampened the economy, but it doesn't inject a lot of new stimulus.
It's more about maintaining the status quo than hitting the accelerator.
That seems to be their read. He said there should be some stimulative effect, but it's not significant over the next couple of years in their view. It doesn't fundamentally change their economic outlook in the near term.
That brings up the topic of Fed independence itself, which was also discussed, particularly in the context of potential political pressure. How important is that independence?
Hugely important. The chair really underscored this. He called an independent central bank a fundamental institutional arrangement that has served the public well. Why? Because it allows the Fed to make tough, sometimes unpopular decisions like raising rates based purely on economic data, the outlook, and that balance of risks we keep talking about.
Not based on politics or election cycles?
Precisely. He explicitly warned that without independence, there'd be a great temptation for politicians to pressure the Fed to use interest rates to affect elections. That would destroy credibility. This independence is widely understood as crucial, he said, for the Fed's integrity and for the credibility of U.S. economic policy overall. It allows them to focus on the long term, even when it's difficult in the short term.
Makes sense. Okay, what about the consumer? We talked about spending moderating, but overall, how healthy does the Fed think consumers are? There's a mention of rising delinquencies among higher-income households.
Despite the spending slowdown, the overall message from the Fed was quite positive about consumer health. Powell stated, "The consumer is in solid shape, and spending remains at a healthy level, even if growth isn't rapid."
Where does that confidence come from?
He mentioned direct feedback from credit card companies and banks. According to them, overall, delinquencies are not a problem, and the performance of credit has been good. Broadly speaking, people are managing their debts.
So those high-end delinquencies aren't seen as a widespread issue.
It seemed like he viewed that as perhaps a more isolated phenomenon, not indicative of a systemic problem across the consumer base. It wasn't raising major alarms for their overall assessment. They're watching consumer spending very closely, of course, as it's a huge part of the economy. But it seems the strength of the labor market is still providing a solid foundation for household finances overall. Inflation and jobs remain the prime focus.
Good data is crucial for all this analysis. There was a question about potential budget cuts to the Bureau of Labor Statistics, the BLS. How reliant is the Fed on that kind of government data?
Extremely reliant. Powell called good data vital, not just for the Fed, but for everyone, government, private sector, the public. He highlighted the U.S. tradition of being a leader in accurately measuring its economy. While the Fed uses lots of newer data sources now, big data, scraping online info, real-time transaction data.
They still need the official numbers.
Absolutely. He stated very clearly that the government data really is the gold standard. It provides a comprehensive, consistent, unbiased benchmark that these other newer data sources supplement but cannot replace.
So cuts would be a problem.
He didn't directly criticize potential cuts, saying they'd make do, but strongly emphasized the need to continue to get better at data, not worse. Less funding means less accurate or less timely information, which makes informed policymaking harder for everyone.
One last quick topic. The dollar? It had weakened recently. Does the Fed worry about the dollar's value impacting inflation?
Powell drew a clear line here. He reminded everyone about the division of labor. The Treasury Department is officially responsible for commenting on the dollar's value. From the Fed's internal perspective, he said the dollar's movements have not been a topic of major discussion at all in their recent meetings.
So it's not a big factor in their current thinking.
It seems not. While a significantly weaker dollar could eventually push up import prices and add to inflation, its recent moves apparently haven't been large or persistent enough to become a major concern driving their monetary policy decisions right now. Their focus remains squarely on domestic inflation and employment dynamics.
Okay, so wrapping this all up, it sounds like the Fed is holding a steady course in uncertain waters. They see a solid, if moderating economy anchored by a strong labor market. But inflation, while improving, isn't quite tamed yet, and now these tariffs add a new layer of complexity, particularly for goods prices. So they're sticking with this modestly restrictive stance, watching the data intensely.
That's a perfect summary. It's a delicate balancing act, constantly weighing the risks to inflation against the risks to employment, all while navigating these external shocks like tariffs. And it leaves us with a really interesting question to mull over, doesn't it? If this modestly restrictive policy continues, and tariffs keep nudging goods prices up, while the labor market keeps doing the synchronized slowdown of both demand and supply, what does that mean for the economy over the next year or so? How might those forces interact and reshape things? Could we see shifts in spending patterns or different pressures in the job market? It's a complex puzzle still unfolding.
Definitely something to keep watching. Lots of moving parts. Thank you so much for tuning into the Quarterly Call. For more episodes, please remember to rate and follow our show. Until next time, stay curious and stay informed.